I want to welcome everybody to this, what I would say, lending fundamentals webinar. It's all about commercial real estate. That's what we're going to talk about here today. As I mentioned before, I'm with Lenders Online Training. I've been here for about 4 years, give or take. And we're proud about this organization where we work with lending credit professionals that really focus on getting to the word of saying yes to deals. I mean, that's what it's all about. So we help you kind of understand a little bit with regards to, what are the intricacies of credit and how we can help them. I'm joined here today with my colleague, very special colleague and fellow senior credit trainer, Joe Davis. Joe, you know a couple people here. Welcome. Glad to have you.
Thanks, David. Great to be here.
Well, everybody, a few months ago in fourth quarter, we shared with many of our followers here at Lenders Online Training that we were going to be focusing on a new initiative for 2026. A new initiative. We were going to create a CRE, commercial real estate lending course, a series. It was designed for teams like yourself, junior lenders, credit analysts, with a strong foundation in evaluating, underwriting, and even monitoring commercial real estate loans. So today, we're kind of excited to share that we are nearing the end of that process, right? We've already gone into production, design, content creation, reference materials, quizzes, case studies. We're all done with that. We're just at that final stage where, a few little tweaks here and there before it becomes a reality. So that's how close we are. Joe, who's here, he has been so instrumental in developing this course. It's really, I would say, kind of authored much of this from his background. So I'm going to say, Joe, why don't you tell us a little bit more about the CRE course and what bankers can do to prepare for something like this here in 2026?
Yeah, thanks, David. Sounds good. As we enter 2026, the new year, I'd be thinking about a few things. First is certainly interest rates, right? No one can predict with any level of accuracy what rates are going to do. So we really have to ensure that the portfolio is agnostic. And the next thing on my mind is the risk of an economic cycle or a recession. Some folks are saying we're already in a recession. Time will tell on that. And then I would really be thinking about additional economic protectionism with, things like tariffs and how that could impact my loan portfolio. And this isn't meant to be political. It's not about politics. It's about credit risk. So those are kind of the things that are on my mind going into the new year. This is why we're developing our new CRE lending course to get lenders focused on the fundamentals, but also some more of those advanced topics, really covering all of the things folks need to know to maintain a healthy CRE loan portfolio. As you said, David, we're progressing through development now. We're targeting a rollout yet this quarter, probably in March. Just a little bit about my background. I've been in banking since the late 90s, mostly in commercial credit and lending leadership roles. Have a lot of C&I experience, but also a lot of CRE and ag experience. Most recently, I served as Chief Credit Officer of a $1.2 billion bank headquartered in Illinois. And really, I am a lifelong learner myself, so really very passionate about learning and ongoing development. So we'll emphasize this is a whole team effort for the Lenders Online Training team with everyone contributing. We're really excited to expand our offerings.
Awesome. So just a little bit about myself. As I mentioned before, I've been with Lenders Online Training for about 4 years now. I have a commercial banking background many years. I was probably started in the late 80s, went through the 90s in those type of roles in commercial banking. Had an opportunity to leave and get into what I would say the private sector, the other side of the table, maybe the dark side, is actually went in and ran a manufacturing organization that was in a turnaround. So I've had that side of the table, as well as in some director roles in other commercial entities. So had an opportunity to kind of get into this practice. I'm also a consultant by trade with America's Small Business Development Centers here in Wisconsin. So that's a wonderful organization. So I am basically a business advisor. I work with this stuff like this every day and have conversations with bankers like yourself as well. So that's a little bit about me.
Great. Thank you,
So,
David.
the purpose, right? Let's just talk about, well, the why, right? You will know basically when I'm an advisor, I talk about the who, what's, and whys. This is the why, a new course, specifically in this case, commercial real estate. So I think kind of the origin when we put our thoughts together on something like this, we can count on lending, credit professionals. They often get on the job training. In some cases, maybe some formal training. Basically, I had worked in a commercial bank, a community bank that was later acquired through maybe some of you, it would have been Norwest Bank at its time in Minneapolis, and they became basically bought out Wells Fargo system. We actually had the internal training department, guys and ladies that were actually teaching credit training. That was what they would do. Well, they eventually kind of scaled out that. So right now, as it really comes down to, is some of the banks and credit unions right now kind of are left to do it yourself, kind of in-house stuff. And I think sometimes trying to allocate the busy schedule of a lender, allocate department heads that are just doing that, their times and talents of lenders, it kind of gets stretched pretty thin. And quite honestly, banks, credit unions, ag organizations, they kind of reach out to outside sources, kind of like us, Lenders Online Training. So we've heard throughout the years, kind of with companies that, they've invested a lot of money in their training. They send a new personnel that goes to training, and oftentimes they're kind of disappointed in the results. And we take a lot of pride in what we do. Some of you may have participated in our Lenders Online tax classes. We take a lot of pride in it. We really want to make sure that we are a resource to you, help you, have conversations so that you can be better lenders, provide value not only to your institution, but actually to your clients to really be a beneficiary for it. So that's the why. All right. What about the what? I always like to focus in. Our intention of the course was really going to be to start foundational. Many of you know that I'm a fundamentalist. I really believe in fundamentals. They don't change. So we're going to start out foundational and we'll get into some complex topics as it goes. That's just who I am, especially if I teach some of the case studies that we get. I get in a little bit in the weeds at times because I think it gets us to be better lenders in what we do. So the content's going to encompass probably the lifestyle, lifespan of a commercial loan from origin to disposition, right? From what do we think at cradle to grave? You've heard that time. So we really want to talk about key concepts, risk factors that Joe alluded to, talking about risk, especially what we're entering in today's economy. Risk has been around for a long, long time. If we even go back to the many recessions that we experienced, and we're going to have another one someday, it will happen. So, cradle to the grave, we'll talk a little bit about due diligence, underwriting, portfolio management. For some of you, have a portfolio of many, many clients, right? And there may be concentrations of certain, whether you do a lot of hotel facilities, whether you do a lot of ag, commercial portfolio manufacturing. So all of it kind of goes together. And we talk a little bit about how do we manage all that? And heaven forbid if we have to do a workout. Now we have a combination of coursework. We do have some real life case studies. That's what it's all about. Teaching you maybe that's the how. And the format will be similar to some of our existing LOT courses. Hopefully you've all participated in that. And if you haven't, check us out. I think they're very proud of what we do. I'm going to point out that the content probably discusses more, what you would say, Joe, non-owner occupied real estate. But quite honestly, when we think about the fundamentals, it can apply to owner occupied properties, even ag. We do this on a regular basis.
Yeah, good point, Dave.
Yeah. So how about we talk about some of the modules? Joe, you want to talk about that? Let's begin with number one.
Yeah, absolutely. And before I move on, though, it looks like somebody has their hand raised on an iPhone. Does somebody have a question? No? Okay. I'll go ahead and start. So, as you might guess, we start out defining some of the terms and concepts that we'll come back to again and again. Think of this as really setting the table, as we'll subsequently focus on those risks, as David's talking about, how we spot them, how we mitigate them. So, some of our participants have experience in other types of lending, but not necessarily real estate. Others are just brand new to banking. And so others are very experienced lenders, have very a lot of experience in CRE, but it's all on the job, and maybe they need to revisit some of the foundation that they missed in kind of a more formal setting. So this course is really a benefit for all of them. This is about level setting to really ensure that all participants start on the same place on the same page. So one of the things I will mention when we're talking about this is single purpose real estate, which comes with its own risks and challenges. I've seen underwriters treat mini storage deals, for example, just the same as other types of real estate. But we should treat those differently and recognize the inherent risks that come along with property like that. So the underwriting, the appraisal, the loan structure should be different than other sort of more general purpose properties. It's just a good example when we're talking about fundamentals of what we're going to cover. So in this module, we'll also touch on the benefits for the lender, including diversification, long-term fixed rates, loan growth, and even CRA, which is Community Reinvestment Act. All those can be of great benefit. So it's not all just about risks coming from the credit guys. It's also about some of the benefits as well.
Then we get into module number two. Now, this one tanks kind of gets into the details of property types and markets. So, what do I mean by that? I mean, we dive into property types, specific areas of risks associated with them. Now, Joe had mentioned before, each property has its own unique characteristics. I've worked with manufacturing facilities, right? That is kind of you would think it's a single purpose in the sense. I mean, however, they can be adaptable. I've had some that are more specific purposes when you get into slaughterhouses and stuff like that. That's a little more single purposes, but you can also comply that to um, assisted living centers. Those can be very skewed down. And actually, the SBA consider that as kind of a little bit of a single purpose type building. So each property has those unique characteristics. We're going to talk about that. Multifamily, which probably Wall can speak to, right? They can be what I would say maybe resilient to the economic times. I mean, although the economy may go in the other way, people still need shelter, but we talk about that. Then on the other side, retail, right? That can be very flippant and based on consumer trends. And we've also noted since COVID, right? Things have changed, right? More people shopping online. It's a lot easier to go to Amazon and buy online than actually go to that store. So we talk about that. This is kind of an old, what I would say, a real estate brokerage type saying, right? It's all about location. So we talk about geography, right? What is that? Location, location, location. That kind of makes sense. Um, Quite honestly, I recall when I was working with um, a hospitality facility, and actually they were going to be doing an expansion on that. So I was working with the bank that was wanted to help me assist in their underwriting. But it was interesting when I got to look at the appraisal. The appraisal in on this facility, the costs are what they are. I mean, however, the value in this, and this was a little bit more of a rural setting, a small community here in Wisconsin. Yet, if they would have built the same thing 20 miles north in a more populated area, it would have had a higher value. So the cost was the same, still used the same sticks and concrete and had to do the same. I mean, they didn't change that. It's just that where it was located, the community that was located. So it kind of impacted the value of that, of what the bank was willing to look at. We talk about things like that. We talk about vacancy, rental rates, all those type of emphasized in the coursework. And sometimes even we talk about construction lending. That's kind of crazy. So how about lending structures and terms? Joe, what do you got on that? Something like that.
Yeah, moving into module three, digs more deeply into the nuts and bolts of CRE loans, such as loan structuring options, typical structures, and regulatory requirements. And we're going to talk both about banks and credit unions from that perspective. The session really covers structuring the loan based on its purpose and the ultimate repayment. And we all know not all CRE deals should look the same. There isn't a cookie cutter approach for every single loan you'll see. There are some common elements that we'll certainly cover. And we'll certainly spend some time talking about loan covenants and regulatory compliance, particularly with LTV limits. We all know those supervisory/regulatory LTV limits were all beholden to starting out with raw land at 65% and going up to finished properties and production ag land at 85%. So we'll spend some time talking about those, make sure that everybody understands what they mean and how those work. So one area I would point to here in this module is fixed and floating interest rates. As I said, we don't know where rates are going. If you look back at the historical data, economists get it wrong. They're wrong more times than they're right. I think it's something like 40% accuracy over the past 50 years or so about when economists predict interest rates. We don't know. So a mix of fixed and floating rates in the portfolio makes a lot of sense. And then protecting your position with things like interest rate floors and prepayment penalties, those also really help to control this risk. We'll also touch on interest rate swaps as a good tool. The point is to really make the portfolio agnostic to rising rates, falling rates, or just if rates stay relatively flat. So we'll spend a lot of time talking about that in module 3. But David, module 4 really gets into a lot of the meat of it. So why don't you talk to us about that?
Sure. I also want to touch a little bit on module 3 when we talked about structure. This kind of goes back to with our program in general. We talk about cash flow, right? We as lenders realize, right? Cash is what pays the bank. So we have to understand that, how we're going to get repaid. It's interesting when we talk about the change of interest rates. Just imagine, now I don't know where some of you are in your banking career, but very short-sighted, right? Just imagine what we went through with COVID, interest rates going up. We many of these clients that were on the books were probably having some loans that were sitting at maybe 4%, 4.5% in their portfolio. They had some, rate maturities, some balloon payments that all of a sudden went up to 8.5%, 9%. So imagine if you have $1 million deal that was kind of cash flowing comfortably at 3.5%, 4%, 4.5%. And now you have to go to a borrower that all of a sudden it goes to 8.5%, 400 basis points. What's that going to do on $1 million deal? So it's interesting. We talk a little bit about this in concept, how we structure deals, how we, what do we use? Sensitivity analysis. How do we stress it? So we like to, and then part of the case studies that we talk about is that is the real world. Now, for many lenders, we were at such a low period of interest rates for a long period of time. We didn't necessarily think about that. I'm old school, been around for a while. I remember when I was lending, interest rates were comfortable in the 8.5%, 9%. I think my first house loan was 10%. So that's just the way things were. When it got down to as low as it was, my goodness, that's amazing. But I never had the flip side. Never had the flip side. So that's what we went through, but it's still in our minds for that. So I just wanted to touch base on that when we're thinking about lending on those, is we talk about those things.
It's a great point. I just hop in right there, David.
Yep.
I think a lot of us stress test interest rates at 100 or 200 basis points. It's kind of the standard. But as David mentioned, rates went up 400 basis points in 1 year. I don't think anybody was stress testing at 400 basis points, but it does happen, and that's the
Yeah.
point.
Right.
Yeah,
So, I mean,
great point.
yeah, those are some of the fundamentals. And when we get into commercial real estate is, okay, how do we do that? How do we consider that, right? It may look like it's going to fail, but I think that's part of stress testing. So we understand what we're going to go into. All right. So income analysis, property cash flow, right? That's it's kind of the main thing, the main risk when we're dealing with commercial real estate. The values are very subjective to rental streams. The amount of money that tenant, whoever it is, if it's a business that happens to be a tenant, or if it's a bunch of tenants in type of a multi-unit residential, it's all about cash flow, those rents. So vacancies lead into issues with cash flow deficiencies. How comfortable are we with that? And we talk about that. It's understanding the tenant base. We look at leases. We get into these lease schedules and charts to say, okay, how many tenants do we have? When do the leases mature? What's included in those leases? We get into the depth of that. escalations. What, is it going to be a year to year lease? Does it go up? Is it a long-term fixed rate? What happens to that? We also have to understand the expense structure of it and who's responsible, right? Sometimes we talk about these triple net leases. And even for when we're underwriting is those CAM fees, common area maintenance fees. What are those? How are they included? And also, who's responsible for the property? What about the HVAC system? We talk about those that all enters the equation when you're trying to understand the risks associated. Property upkeep, all those risks impact the property condition. Now, day one, we're looking at it. So it's either a new building or we just had an appraised. But many of these properties are on the books for 15 years, 20 years, 25 years. A lot can happen to the property, the neighborhood. So we get into those type of conversations. Now, of course, we talk about cash flow and we talk about debt service coverage and all those basic lending things, but it also applies to commercial real estate. And we give you some real examples when we walk through that. So it talks about assumptions that we as creditors, what do we think about? We talked about stress management as far as understanding what can happen with the property and what we feel comfortable with in understanding for a long-term outstanding deal. That's module 4. What about module 5?
Yeah, yeah, absolutely. So module five, it really follows logically along the paths. We just talked about cash flow. Now we get into value, which is certainly reliant on the cash flow. So proper collateral valuation is just key to a healthy CRE portfolio. We'll dig deeper into appraisal methodology and best practices. I really, in my career, I find that many lenders don't really understand things like cap rates. And so they don't feel confident to assess the appraiser's work. So they just kind of accept the appraisal and the appraised value without giving it much thought. They just kind of look at page one and say, all right, that's what the building's worth. But we really wanted to demystify concepts like this as part of the course. Lenders should absolutely understand things like cap rates, and then they should apply that while reviewing those incoming appraisals. In my career, I've found many errors and really some questionable assumptions, questionable comps in appraisals. And you always have to maintain your independence. It's a requirement, a regulatory requirement, but you certainly can ask questions of the appraiser. Hey, I noticed you used this number on page 6, but in the commentary you said this in page 7, for example. Sometimes they will change it. Sometimes it's just frankly an error on their part. So while maintaining that independence, it really does pay to understand the appraisals, take a deep dive into them when you receive them, push back when you feel it's necessary, ask questions when you feel it's necessary. So we'll cover appraisal subjectivity and the importance of an appraisal review process. We'll also discuss evaluations as an alternative to appraisals. There's some pros and cons there, right? And I'm talking about internal evals. Obviously, the time frame and the cost balanced against detail and accuracy. So we're often walking that line to figure out what I don't want to say what we can get away with. I want to say what's most appropriate in policy and also in align with the regulations. So then we get into a case study, right, David?
Yeah. Touch a little bit on collateral evaluation from my perspective. I think it's critical. I think it's really one of the fundamental C's of credit,
Yeah.
especially when you're dealing with, commercial appraisals, whether it's, they use primarily the income approach, cost approach. They'll do a sales comparison, but that's kind of challenging, right? To get really like comparisons of commercial properties, especially nearby in the community. I think it's very, very difficult. And let alone, as I mentioned my example before, you take a property that was expansion with new materials, you move it 20 miles north into a more populated area, all of a sudden the value is higher. So it's really weird when we are lending to say, okay, it's just, I'm lending at the property here. What do I feel comfortable with knowing that the cost is even more? So I think it's interesting that. So
Great point. Yep.
case study. Yeah, this is, remember I talked about why. I talked a little bit about what. Case studies, that's all about how. This is where we kind of roll up our sleeves. We spend some time with a case study. This one's about a strip mall. So understand that. So it's not a single purpose building, but we're dealing with tenants. And how do we understand that? Whether it's depending on how many units is, but how do we understand that? And we're going to actually use an income tax return and a template to kind of go through it with you to determine the net operating income and the debt service coverage. So it does bring into the financial side of the tax return as far as how they run that. We'll actually talk about cap rates. Remember, Joe had mentioned before that's a little uncomfortable. Some people just haven't been introduced to that. I think it's an excellent understanding to be aware of. So we'll give you that. We'll have them maybe do a perspective of some strengths, some weaknesses. People will know me as far as in our Lenders Online training program. I talk a lot about red flags. Now, red flags aren't necessarily the danger signs. They're not what I would say a deal breaker, but they're things that just seem to be unusual, out of the ordinary, or just something it just doesn't seem right. I want to know more information. That's what red flags are. And oftentimes it's having a conversation with a client. Maybe they don't understand them, but it's just getting some clarity. So we'll talk a little bit about that. Does bring in the number side. That's the objective side. The subjective, well, that's what we get into understanding as to what are the other things on the fringe that we want to talk about. Now, we do in our case studies, the participant is able to review and discuss their work with myself, Joe. You talk to us about it. Now, it's very hands-on. There have been some times when my answers, Joe's answers are slightly different than the participant. Slightly because we don't know what your guidelines are. It's all about guidelines to your organization and what you feel comfortable with, but we have those conversations. I think with many junior lenders and analysts, I mean, they focus solely on probably getting the numbers right. We just want to make sure I got the numbers. But it's the context, I think, is important. We had a conversation today when we were talking about balance sheets, my favorite item, and we got into the context of the balance sheet, all the things that stand beyond the numbers, the context that it's important, the real part of the story. So we talk about that in these case studies. So a little bit about the why, the what. The case study is all about the how. Joe?
Yeah, great points, and avoiding that elevator analysis as always. Then module 6, next topic is it's all about risk. The types of risk most common with CRE, how to properly identify that risk, and then some mitigation steps that can be taken. We'll cover the identification of risk through proper due diligence and underwriting. And we'll talk about risk layers. And when I say layers, I mean deals with multiple related or unrelated risks. That's a main area of focus. With commercial real estate, risk layers usually arise because the primary source of repayment, which is cash flow, drives the secondary source of repayment, which is collateral value. So when cash flow decreases, you're usually in a very bad spot. That's a primary example of a risk layer. So that's why we go from module 4, talking about cash flow, right into module 5, talking about valuation. They're related much more so in CRE than any other kind of lending. In our initial survey, when we were talking about rolling this course out several months ago, we talked to people, and lenders really indicated they wanted to learn more about stress testing and sensitivity analysis. David did a nice job of talking about this. We'll spend a lot of time talking about that, making assumptions for factors like occupancy. What happens if occupancy goes down by 10%? Factors like interest rates. What happens if, as David said, interest rates pop up 300 basis points in the next year? We'll also sensitize the cap rate. And we'll look at those things both individually and collectively. You can look at those, and that can really help to assess the risk in a deal. So this module will also include information on risk ratings, particularly their regulatory definitions, right? All banks and credit unions have their own system, but we're all beholden to the same risk ratings from our regulators. So that is, when to call a CRE loan criticized or classified. And we'll also have some information on non-accruals, what that means and the mechanics of it. I find that a lot of the times people don't really understand when something should be classified and on accrual or off accrual. So we want to talk about that. cover the regulatory definitions and also some of the accounting implications of those risk ratings as well. Then
Our
module
next mod,
seven, yeah.
yeah, our next module gets into monitoring and portfolio management. This kind of really parallels a webinar that I do in our classes that talks about credit risk readiness. What happens? What do we need to be aware of? Now, in that type of webinar, we talked a lot about recessions and the impacts of how that happens with our portfolio. And then we get into a survey that our founder, Linda Keith, had done, reaching out to credit analysts, bankers, both at a senior level as well as a junior level, and tried to understand basically where their thoughts were with regards to just the economy and how it impacts their portfolio. So we talked about covering the portfolio, and now that may be a slightly senior level position. Someone, the chief credit officer, has to be aware of all the loans that they have on their books, what their concentrations are, which credits are doing well, which ones are not. We also have the individual auditor, us, the banker, the analyst. What's going on with the individual client? How are they handling it now? They may have several different properties, multi-units of several size. So that's very complex with just the individual credit. But if we have a lot of residential multifamily units, okay, that's a big sector. We talked about hospitality, hotels. That would be a big sector, right? It takes up a lot of dollars, but how does it impact when an industry sector kind of feels the pain? What happens? I mean, take, for example, COVID, right? It impacted all of us. If you have a lot of hospitality areas where people aren't traveling, what does that do to your portfolio and how do you manage it? So we get down a little bit down to the Main Street area when we talk about, all right, site visits. I think it's an ongoing thing. It's not just a matter of when we get our financial statements and we review them once a year, but we do some site visits, what the property looks like, maybe meeting the client at that, depending on what, to see what's going on there. Are there any signs that may just sense that there might be some cash flow challenges? Maybe the upkeep around the grounds isn't quite like it used to. It aged very, very well. Maybe internally, right? Maybe it's like it looks tired, right? When's the last time they've put some money into it? If we're looking to fund maybe it's a larger project, we'll say a hotel or motel, but it's 20 years old already and someone else is buying it. All right, is it time for a facelift? What does that do into your portfolio? Now, it's easier when you're looking at delinquencies. Joe talked a little bit about delinquencies. We talked a little bit about that. What seems to be reasonable, what are watch listed, and eventually what expected losses are we looking at? So we get a little bit into that as well. Well, then let's say it doesn't work. How do we deal with the probably the not so glamorous part of the job? And maybe there's departments at one of your organizations that originally deal with that. Workouts. How do we move them? When a problem loan comes up, what are the challenges that we have to deal with? Most likely the value has decreased. Do we as lenders want to be in the real estate business? What does our organization deal with that? Or how do we deal with the exit strategies, or in some cases, retain them? Because we all know that what Joe had made a mention on specifically what's unique when you're dealing with commercial real estate, the revenue streams, that is important for the value of the property. If the revenue streams start to go the other way, there's vacancies, the value goes down as well. So there are times when I am more or less a personal investor in perspective, commercial real estate is interesting. Those properties sometimes don't appreciate as often that we would think of our homes. Those seem to appreciate on a regular basis. So we touch a little bit on that as well. Module 8, Joe, loan documentation.
Yeah, absolutely. We dive into loan documentation, module 8, and as well as title insurance. This really highlights the main loan documents and what each is used for. Things like the note, the business loan agreement, assignment of rents, etc. So, but an example I really want to mention here is the SNDA document that stands for Subordination, Non-Disturbance, and Attornment Agreement. You can see why we use the abbreviation for that, right? That might be a new concept for many participants, but it's really good for them to have in their toolkit. And just in a nutshell, an SNDA is a tri-party agreement between the lender, the borrower, and the tenant. Keeps everyone aligned specifically in a loan default scenario. So I find a lot of bankers, particularly community bankers, have never heard of this document or don't really ever use it, but there's a time and a place, especially for some of those larger non-owner occupied facilities. We then talk about documentation issues leading to loan losses. This is just low-hanging fruit. So a doc review process is really fundamental, really getting multiple sets of eyes on those loan docs before they're executed or shortly after they're executed while everybody's still getting along and we can still correct any issues that come up. And then we take a look at title insurance from just the basics. What is it? How does it work? Then we get into various endorsements, really just the most common endorsements that pop up with CRE lending. So similar to the appraisal process we discussed a little while ago, you shouldn't just blindly accept the policy and recommended endorsements from the title company. Like I always say, never outsource your underwriting and risk management to anyone. That includes the appraiser and that includes the title company. So we want to arm people with, the toolkit and the experience to be able to determine what type of title insurance that they need for a particular deal. And then module 9, David?
Module 9 is kind of a recap. Basically, that session really talks about the diversity of all the learning process. I mean, it includes some podcasts, some materials that were created, curated from our founder, Linda Keith, throughout her years. I think our teaching process really is not only the modules, a little bit of as far as, some examples within those modules, a lot of our personal touch that Joe and I, when you have one on one sessions with us in the case studies. So it's very hands on, and we talk about commercial real estate fundamentals. So, what we want to do is really provide you not only kind of some of the book stuff, but also to expand your understanding of commercial and real estate as far as into your world. This is professional development with you and understand what you're really getting into when you're talking about a lender situation where someone wants to buy commercial real estate. It's a loan, right? It's a loan. I can increase my portfolio, but we help you understand that. But we want you to have some of the tangible things to take away. Joe, what about that final case?
Yeah. So after the final module, we get into the final case study. This is a really realistic scenario. It's the purchase and renovation of an apartment complex. Many of us have looked at deals similar to that. So we give participants detailed information and we ask them to analyze the opportunity and provide a recommendation. It's kind of it made me think about it as leading up to that pre-qual meeting or the flagpole meeting or whatever banks want to call it. It's really intentionally open-ended. So in that way, it's pretty realistic to people's day-to-day job. The participant then, so they get all of their analysis together, and then they have the opportunity to review and discuss with one of our credit trainers, so either me or David. So this ties everything all together and ensures the participant really understands the core concepts from the course. Everything from the basic number crunching to the research and the due diligence on through to the recommendation. Again, ensuring a combination of those qualitative and quantitative measures. And we give some tangible takeaways as well. Each module comes with a 2 to 3 page reference handout for the participants. So they'll build a library as they progress through the course, which is similar to our existing reference manuals. Then these handouts, they include space as well for the participant to note their company's policies and procedures. So it will be specifically tailored to each institution. Because as David said, we don't know every bank's policy and procedure. We know basic risk management and we know regulatory, but each bank is different. Each credit union is different how they want to look at it. So people will be able to tailor their learning really to their specific institution. David?
Well, folks, there you have it. So, kind of customized to your organization, the fundamentals, we teach you that not only through some of the modules of what you're reading, watching some of the videos. You get to have one-on-one with us. You get the case studies. We will then sometimes have those conversations provide you some context as to how you take it back to your organization. We've always taken pride ourselves that this is something that develops that your organization can take and be proud of. Yes, there's some fundamentals involved that can be brought against any other institution, but we try to tailor it a little bit to you. So, key fundamentals. Every junior lender, credit analyst, when they're underwriting commercial real estate loans, quite honestly, Joe, I think it was a big undertaking by you, our organization. I think it's exciting.
Yeah.
Something that for all of you that are here today, if your team needs a deeper understanding to try to analyze CRE deals. Now, yes, some of them may be non-owner occupied, but in our conversations, some of this can be applied to owner occupied. But commercial real estate is often a large part of our portfolio in some way or another. We're attaching that because of the collateral value. So, real world scenarios, tools to help you say, as our tagline says, help you say yes to good loans. Joe, any final thoughts?
Yeah, please. We're offering 30-minute overview meetings with one of our senior credit trainers, either me or David. So you can schedule one of those at lendersonlinetraining.com/talk. It's in a link there, and would love to talk to you more about it.
Does anybody have any questions they'd like to ask while they have David or Joe here?
No, not yet.
All right.
Okay.
We're good.
Thanks, everyone. Appreciate
Yeah,
it.
thank you.
Thank you so much. Thank you. Thank you. Bye bye.
Take care.
Bye.